Yeah, in this session, we'll be dealing with time series analysis data, wherein the data which we would be looking at follows a kind of a time series. Means we will not have the observations taken at a point in time for various records, for various observation, but we will be taking for a particular company or for a particular value across time. So when I have the data something like this, let's say in this spreadsheet I have the data right from January 2010 on a monthly basis, what has been the stock index Sensex value. So this kind of a data where the time is a critical factor. Across various points in time, I have collected the values of one particular variable. That kind of a data is what I call as a time series data. And when it comes to the time series data, our intention is to primarily first understand, is there any kind of trend? Trend is an aspect talking about moving with time. Is there any kind of values increasing with time or falling with time? So that is one aspect. And then we may also have to look at, is there any kind of seasonality that is present in the data? So we'll first start off with how do I look at the time and the presence of time in the data, trend and the presence of trend in the data. For that we have two major aspects to look at. One, we look at a linear trend, and the other one we look at as a log linear trend. Any of these kind of trends present in the data is what we would be checking out for. So when I am talking about a simple linear trend kind of a model, the simple way to work out a linear trend model is, so you have the values across time and you take time as one more variable. And when you are taking the time as a variable, right from the first period, you start off saying 1, 2, 3, 4, so on. So this is a time variable which we have. Now we can do the regression taking this as the independent variable and our actual variable as a dependent variable, and based on this create a regression equation. And that is what is the first thing that will typically check out for the presence of trend in the or for the presence of linear trend in the variable. Okay, so if I try to execute this as a simple regression, wherein I am more interested in, I'll remove these variables, I am more interested in taking the Sensex as the y-axis, the input y range. I take the dependent variable which is let's say the Sensex, and I will take the time as the independent axis. That is what is the first aspect of a linear trend kind of a model. Alright. So when I say okay to this linear trend model, okay, let's see here what is happening. The R squared is 0.22 and the intercept is 17,255 and the time is 46. So probably I could have written this equation as YT or Sensex at point T, Sensex at point T is 17,255, I am rounding it off, plus 46.61 times the time. This is the equation, and of course the mechanism is as simple as your simple linear regression, and the mechanism that has been used to derive this a and b, just like your simple linear regression, a plus bx kind of thing. The only thing is, instead of x, which is the dependent variable, we take time in the form of 1, 2, 3, 4, and instead of a is the intercept itself. And this mechanism, just to reiterate, this is an OLS mechanism, ordinary least squares method of doing the regression. Right? The A and B are typically derived from the perspective of making sure that the error is minimized. Y I equal to A plus Bxi plus epsilon, and that intention of finding out A and B is based on minimizing the square of the error. So based on this, we got this kind of an equation, and the betterment of this equation, is it a really good equation or not, are these coefficients statistically significant or not, we can check out from the p-values. The p-value is less than 5%, very much less than 5% for the time. So, and at the same time, overall model also, the p-value is less than 0.05. So we cannot reject the null hypothesis. We have to reject the null hypothesis and say that time is an important factor in the determination of the sensex for the next period, and the model is overall a fit kind of a model itself. But when you look at R squared, the value is not that high, so it is probably the influence is much weaker compared to what it should have been. Probably if I can get a better model, it would be more and more preferable, but it is not something that can be ignored also, because we are seeing that time is a decent factor. Time is a significant, statistically significant variable in the determination of the value of the sensex. So if at all I want to predict what would be the sensex for the next period, I can typically substitute 50. Now, right now it is 49. So for the next period, if I want to predict in the same thing, probably for the time, take it as 50, and you say that the next period prediction based on this model should be intercept plus the coefficient of time multiplied by the time value, which is 19,586 is the value that it predicts. And at the same time, you can build a 95% interval around it. But some small observation, the standard error seems to be very, very high. So the standard error of the forecast also will come out much, much higher, which will result in a very weird output for us. But just to start with, this is one way we look at, this is one way which we can look at for evaluating a time series model. I would first check out if there is any kind of a trend that is present in the model. The other way the same thing could have been accomplished is just simply plot a line chart for this. Just simply take a line chart, right? Probably a line chart for this data. This is your line chart, and if possible, you attach a trend line to it. This is the typical trend line, and what we are seeing here is there are so many points which are much above the trend, again coming down, again going up. That is the kind of a pattern that is being observed. So we have to really evaluate, is there any better model rather than the existing linear trend kind of a model itself, which is explaining or which is helpful in predicting the price for the next period, predicting the sensex value for the next period. The next item that we can think of looking at in any time series analysis is, okay, if the linear is not that great, Why can't I look at a log linear kind of a model? That's the second thing I would like to look at, right? The log linear model. So in a typical linear model, we were thinking of the expression as yt is equal to a plus b into t. This is what was our, and plus some error. This is what was our linear trend model. When I say a log linear trend model, it comes out as yt is equal to e power a plus bt. This is what we call as a log linear trend model. So applying the logarithms on both sides, we take logarithm of yt is equal to a plus bt kind of a model. So the y, the output, I typically take the logarithm of the output and then try out the linear relationship between the variables to check out if I do some kind of log linear trend, is there any kind of a log linear trend that is present on the model compared to a linear trend. So for that, all I will do is the y values, I will take their logarithms. So I will simply say logarithm of this particular sense x value. Okay, so now this will become my dependent variable, whereas this itself is the independent variable. Now a new regression is being planned out. Right now a new regression is getting planned out with the log sense x as the dependent variable and sense x and the time as the independent variable as it is. Now when I am doing this, I see that the r squared is only 21.49, and probably here also, if I am looking at the time 0.002, and it is saying that even though the coefficient is 0.002, the coefficient is statistically significant, it cannot be taken as 0 because the p-value is much less than 0.05, and overall the fitment of the model is also good enough because the overall ANOVA significance level is also less than 0.05. But what we are seeing is the r squared has not improved anything great, or in fact it has fallen a little bit. In this, when I took the linear trend model, it was almost 22%, whereas here it is only around 21.49. So probably even in this case, after doing a log transformation, this is one of the kind of transformations that I am trying to do on the data. Even after doing a log transformation, in this case the estimate or the accuracy or the prediction reliability of the model has not improved anything in a great way. So the first thing that we do whenever we come across a time series data is try looking at if there is any kind of trend in the model. So that trend I can observe either as a linear trend or as a log linear trend. Now out of these two, which one I need to choose depends on how my data is looking like when I am using both of them. When I plot a graph with the original data, which we have tried out, when I plot a graph with the original data, I see something going up and going down kind of stuff. But if I see some kind of a pattern of increasing at an exponential rate or falling at an exponential rate, then I see a log linear trend model would be a much better fitment. So when the variable is moving at a more constant rate, then we see that the log linear model is more and more appropriate. But if the growth, so here probably I can differentiate between, is the growth happening by a constant amount? If it is growing by a constant amount, then I say a linear trend model is more appropriate. But if the growth is by a constant percentage growth, then probably a log linear model is more appropriate. And it may so happen, just like in the current case, none of these two models may be that flexible enough to be used for some kind of time series data. Then we have to look at a couple of other mechanisms to address this kind of an issue, right? So because the trend models, whatever we are looking at, one thing is they go with an assumption. Yeah, the most important thing here, when I look at any kind of trend model, I go with an assumption that or any regression model typically which we are using, we have one assumption in the regression model which says the residuals need to be uncorrelated with each other, right? Residuals are independent of each other. But whenever there is some kind of a trend present, probably for some periods the value may be much higher, for some periods the values may be much lower, which means there is the residuals whatever are coming up, they may not be completely uncorrelated with each other in this kind of models. It's very difficult for the residuals to be uncorrelated with each other. There is a possibility of some kind of dependency in the residuals from the last period to this period. Probably it may so happen that when the last period values are high, probably there is a chance that this period is also high, because there could be a gradual fall in the value but not a sudden drastic fall in the value. So because of that, there is a good possibility that the relationship may exist across the residuals with respect to time. So when we are looking or dealing with time series, a serial correlation, or sometimes we use it as autocorrelation. This is one aspect I said we would be dealing with time series analysis. Though I had it as a part of a multiple regression, I said it would be more appropriate to deal with time series kind of a data, because autocorrelation or serial correlation is the residuals having a dependency on each other for a continuous set of periods. So the other way is, if I try plotting the residuals, okay, now let's say this is our regression model, right? Using this regression model, if I do a prediction, assume I'll go with the original itself, not the log transform, the intercept plus the coefficient times the time, right? Now you see, if the predicted value should be something like this, and from here when I take the error as the difference between the actual value minus the predicted value, so these are the errors that are coming up. And what I say is, if I plot a graph of these errors, you see some kind of pattern is there, okay? For some first few periods it is positive, and after that for next few periods it is negative, and again for small periods up and down. So you see some kind of correlation is existing between the errors in a significant manner. The other way probably I could check out is, take the correlation, probably take this error, right? Look at this error, and with some kind of a time lag. So what I say time lag is, so try to map, right? Probably I'll say I'll do the correlation of the error from here to one lesser up to here, and the other variable I'll take it with 1 period lag. The other variable, let's say I start from here and I take it till the last, just to check out whether the correlation is existing between the error terms. What we could see is there is a correlation of 0.73, and even if I apply a statistical test, hypothesis test on the top of it, there is a very good possibility that the null hypothesis of R equal to 0 will be very much rejected. So there is a decent relationship that is existing between the error terms. That is one more thing that we have to be cautious of. There is a possibility in these kind of time series models, there is a possibility of the presence of autocorrelation. So one way is check out for that correlation, and just to test out that autocorrelation, we have a mechanism called whether the autocorrelation is really present or not. For that we have a mechanism called Durbin-Watson statistic. So we have to really apart from just looking at the correlation like this, we would also go ahead and use the Durbin-Watson statistics to really check out what is the level of correlation that is existing between the error terms, which means direct usage of the linear trend or log linear trend models may not be that effective, at least for this kind of an example. So it has to be looked at on a case by case basis itself. But in this example, because R squared is much lesser and all these things, it is so appearing that there is a lot of autocorrelation that is existing, but we can confirm it using the Durbin-Watson statistic. So let's start using the Durbin-Watson statistic on this data, and based on that see if serial correlation exists, and if at all it exists, how do we address that. So the way I use the Durbin-Watson statistic is we have already in the data, we have taken the error. What you do is you take the time lag of the error also. So this error minus the previous period error. For each of the period, you take the current period error. So we can start from the second period onwards. The current period error minus the previous period error. So which is nothing but the Durbin-Watson statistic simply goes as error of t minus error of t minus 1. Do the squaring of them and add up. Probably because here we may have to start from the second period onwards. Divide this by error of t square. This you can do right from the first period onwards. So whatever the value that comes out, that is what we call as a Durbin-Watson statistic. Okay, so here I'll do the same thing. I do the square. Okay, so these are the numbers. So the numerator of the Durbin-Watson statistic is this. And whereas when I have to talk about the denominator, I'll simply take the square of the error directly. The square of the error is what I am taking directly. So from this it so comes out that my numerator, or probably if I have to find out the Durbin-Watson value, it is nothing but the sum of all the numerators divided by the sum of all the denominators. So this is what is the Durbin-Watson statistic, which we have got it as very much close to 0. Right? The Durbin-Watson value here is coming out very close to 0.00008. So the Durbin-Watson statistic value is very close to 0, and what it also says is, you equate this Durbin-Watson, especially if your sample size is very large, you take it approximately as equal to 2 into 1 minus R, where R is the correlation, autocorrelation that is existing. So in this case we got Durbin-Watson as 0, 2 into 1 minus R. So from here you can say 1 minus R equal to 0, and probably R is coming very close to 1. R is coming very close to 1 is an indication that there is a presence of serial correlation very heavily in the data. That is one way. Either you compute the correlation between the error term, or you use this Durbin-Watson kind of a statistic to finally arrive at equating whatever the statistic you get. Try equating it to 2 into 1 minus R. So basically whatever the value that comes out would be an indication of the correlation. So the other way to interpret is, generally, because we are talking about 2 into 1 minus R is the approximate value, we see that the Durbin-Watson will lie between 0 to 4, because R will lie between minus 1 to plus 1. If I substitute minus 1, this becomes 4. If I substitute plus 1, this becomes 0. So I say Durbin-Watson lies between 0 to 4. So what we say is, when the Durbin-Watson value is somewhere around 2, it means R is somewhere close to 0. So probably some limit on the lower side and some limit on the upper side. So as long as my Durbin-Watson value lies in between these two, then I don't need to reject the null hypothesis. What is my null hypothesis here? There is no serial correlation or no autocorrelation in the data. Whereas the alternate hypothesis simply comes out with there is an autocorrelation. So if the Durbin-Watson statistic comes between DL and DU, then I don't have any evidence to reject the null, so I can say there is no autocorrelation between the data. But when it lies somewhere here, then I can say that there is a positive serial correlation. When I say positive serial correlation, probably probably I should look at positive serial correlation. The next value, if the current value is positive, right, if there is an increase compared to the previous period, there is a high chance that the next period also it is an increase. So there is a high chance that the increase will be followed by an increase and a decrease will be followed by a decrease if the serial correlation is positive. And if the Durbin-Watson comes in this range, I say that there is a possibility of serial correlation to be negative. And when I say serial correlation negative, there is a high possibility. If today this is an increase, there is a high possibility that the next one will be a decrease, and vice versa. So in our case, we got the Durbin-Watson value very close to 0, which means there is a possibility of a presence of high serial correlation in the data. Even that particular aspect needs to be looked at from the perspective of time series analysis. That's one more dimension that is advised before we progress any further on the time series model. We need to understand whether the serial correlation is present in the data, and if at all it is present, if it is present, what will happen? There is a possibility that our standard errors in the regression model, the standard errors may get very widely affected. Probably these will come out as much smaller numbers, right? There is a possibility that the standard error will come as smaller numbers. Because of that, the t values can go much higher and the p values can go much lower, which means we may end up rejecting the null hypothesis, whereas we should not reject the null hypothesis. So in some cases it may so happen that we end up rejecting the null. So incorrect rejection, there is a possibility of a type 1 error that can come out very heavily, especially in case of a presence of serial correlation in the data. So it has to be identified and removed. Removing again is there are various methods to remove them, but again there is a Hansel's estimate wherein the standard errors are modified. So that modified standard errors are represented here, and again the model is being retested. That is one way we can try to remove the serial correlation, and there are various other mechanisms also to work out on the serial correlation. But just on a testing standpoint, apart from just plotting the residuals, even a Durbin-Watson statistic can give us the necessary advantage of testing out whether a serial correlation is present in the data or not. Right? Now the next aspect that we need to look at is from the dimension of autoregression, because once we detect there is some kind of autocorrelation, then the next thing we may have to go out with is, what if I can do the regression on an autoregression kind of a model? We'll try to explore that particular process now. So now getting into the next aspect of autoregressive models. So especially with the trend model, if I am seeing too much of serial correlation present, we will try looking at autoregression kind of models. As the word itself is saying, when I say autoregression, I am trying to do a regression on the data. Right, let me try to take this to a separate sheet so that we can work out much better. Okay, when I am trying to look at autoregression kind of a model, we are trying to look at regressing the same data. Let's say if I am having yt, the formula go like this: yt equal to a plus b yt minus 1. So it's not some other regression, it's not a regression with respect to some other variable or anything. We are trying to do a regression with respect to the same variable but with a few periods gap. So depending on what is the gap that is coming in, we call as autoregression of that particular order. So if I am bringing in yt equal to a plus b into yt minus 1 plus c into yt minus 2 plus so on, then it becomes a second order, so it becomes an AR2 model. But probably here if I am going with some x into yt minus n, then it becomes a AR of the order n. So it will be written something like this, means the current period's value is dependent on the previous n period values. That is what is the meaning behind this. The autoregression model of nth order means the value of the current period is dependent on the values of the previous n periods. So here we may be using a regression model to address these kind of things. And so let me try taking that particular data, sensex of t minus 1. So what I will do is here I will take the previous period's value. Here I will take the previous period's value, right? Now I can do the regression now. When I am doing the regression now, let me do it. The dependent variable this time is from here to here, and the independent variable this time is from here to here, and I don't have labels this time. And if I am doing this, okay, here we see the r squared has come out quite comfortable this time, and even the equation has come out in this way. Now what is the equation for us? Yt is equal to 3881 plus 0.7936 times Yt minus 1. This is the expression that is coming out using the auto regression kind of a scenario. Now using this, probably once I know what is the current period's sensex value, I may think of using this model to predict the next period sensex value quite comfortably. So that is one way we can work out on this. But if at all I have to use this kind of a regression model, it is expected that my time series, whatever the data, my time series, if at all I have to use this kind of ordinary least squares method of finding out A and B coefficients, my time series needs to be what is called as covariance stationary, an important term to talk about. My time series needs to be covariance stationary. What it does mean is, I take an expected values or the means of the data for any set of for any few sets of values, probably the last 1 year, 2 years, a continuous, at any point in time when I take the expected value of the time series, it should be more or less constant. Similarly, if I take the variance of the time series, it should be more or less constant. It should not be increasing with time or something like that. The variance of the time series should be more or less constant, and the covariance between any two pairs of any lag, even that needs to be constant. So only when all these things are there, what it does mean is, if I look at the data, let's say I take the mean of some specific values, okay, these many values, the mean is some 18,185, then probably, okay, Jan 10 to September 11, the average is 18,185. Again here, if I take Jan 11 to September 12th, the mean is something like this. So the mean should be more or less in a constant range, whatever is the various time series I am taking. Similarly, the variance also should be more or less constant, and the covariance with any kind of lag, even that needs to be more or less constant. Only then we call that particular time series is covariance stationary. And once it becomes covariance stationary, I can use this ordinary least squares method of regression to typically do the prediction part. So in this case, yes, few things, r squared has improved quite drastically, and if you see here the x variable 1, the p value is much lesser, contributing to a good significance level. Even if the correlation is, even if the coefficient is 0.79, it is statistically significant. Now one more thing what I can typically think of doing is just to check out whether the autocorrelation is present or not, right? I can take the error terms, I can now, assuming that this is my model, based on this model, probably assuming I am going with the AR1 model, this is an AR1 model itself. Based on this, you find out the residuals. You find out the residuals based on this particular model, and see whether this autocorrelation, whether the correlations between the various residuals, are they more or less, let me just give you that flavor. So here what I will try to do is, I will try to do the prediction using the new model. What is that new model? 3881 plus this value times the sensex of the previous period. This is the sensex of the previous period. So based on this model, probably these are my predicted numbers. So from here I can even think of the error part, right? So let me go down. Okay, here when I am looking at the error part, which is the actual value minus the predicted value, this is the error. This time when I want to take the correlation between the error with one time period lag, the error with one time period lag, I'll take the correlation between up to here, comma, this one. I'll try to take the correlation between these two pairs of data. It's coming out very close to 0 here. The same way I can take it with a 2 period lag, means from here till n minus 2, and from here, probably if I want to look at with a 2 period lag, the correlation is going to be between this two. I'll omit two values here, between this to this, comma, this to this. So when I am trying out between two periods also, this number may not be that significant. So I really want to check out, if at all, again with 3 period lag, 4 period lag, I may do it with a 12 period. Let me try it with a 12 period lag to see if there is some kind of a correlation, so that I can explain it much better. Okay, there is a 12 period lag, so I'll omit 12 values here, 5, 6, 7, 8, 9, 10, 11, 12. So these are the 12 periods which I am omitting. So from here again I will omit 12 more values from the top. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 values from the top. So when I omit these 12 values and find the correlation, even this is not that significant. So I'll try out various combinations, and of course here if I have to test out, in case of autocorrelation, the test that we generally apply, right, for a regular correlation we were using a statistical test, which is T is we are using correlation into square root of n minus 2 divided by square root of 1 minus r squared. That is what we were using. But in case of autocorrelation, we directly tested using the correlation whatever was existing divided by 1 by square root of t, or square root of 1 by t. That is again we look at it with a t distribution with t minus 2 degrees of freedom. So if the sample size, this is purely based on the sample size. Now let's say with a 1 period lag, what is the total sample size here? Let me just check out. This is 48 and we have used one lesser. So the sample size was 47 for a 1 period lag. So what I'll do, or probably for a 2 period lag, the sample size is 46. So what I'll do is I'll divide this by square root of 1 by 46. This is what I'm dividing with, square root of 1 by 46. So the calculated t value is coming out to minus 1.25, and for me the critical value is t minus 2 degrees of freedom. T is 46, so 44 degrees of freedom is what I will look at. So the t inverse with a 5% significance level and 44 degrees of freedom, it is coming out to 2.01. So as long as my computed value lies between minus 2.01 to plus 2.01, I cannot reject the null hypothesis of correlation equal to 0. Otherwise, I may have to reject the null hypothesis and say there is a significant correlation present. Here, because I got minus 1.25 lying in between, I cannot reject the null hypothesis at 5% significance level. So I can very well say that there is no relationship, no serial correlation that is present in the data using this kind of a model. So that is what is the way we go forward in terms of using autoregression as a part of estimating our model. It may so happen that when you are using 2 periods instead of just 1 period, in this example I was talking more about a 1 period model itself, but it may so happen that you may have to use a 2 period or a 3 period. You may get much more better R squared, much more lesser standard errors kind of thing. That would improve your estimate more compared to any other approach. That is an improvement that you can try out on the existing models. So basically you have to test, you have to even if you have created an AR model, the way you can test out that AR model is by finding out the autocorrelations at various intervals and then testing out those autocorrelations using the t statistic and then confirming that your data is not having much of autocorrelations inside it. So that's the next aspect. Okay, so now we will move into few more interesting aspects with respect to time series analysis, which we call them as the mean reversion kind of mechanism. The next thing which I would like to handle with respect to the time series model is the concept of mean reversion. See, when we talk about mean reversion, it means that my data, in this case the Sensex data, has a tendency to move towards the mean. Means if at all the value is gone very high, there is a tendency that it will come back to some long-term average value, and if it has gone much lower, it has a tendency to come back to a average value. It's basically like, okay, this is the typical mean level. Right now if the value is this much, there is a chance that it will come back here, and probably if it has gone down, there is a tendency that it will go back here. So when I define one long-term mean level, all we are saying is our data has a tendency to bounce back to the mean if at all it exhibits a mean reversion, and it is expected that mean reversion is one of the key characteristics of a data which is covariance stationary, because we said expected mean is more or less constant. If the value is completely increasing or continuously decreasing, there is no way the mean can be constant over a particular period of time. The mean can keep continuously increasing. Only when that data is more or less mean reverting, then only we will see that it exhibits the principle of covariant stationarity, and only when it exhibits the principle of covariant stationarity, using an autoregressive model with ordinary least squares mechanism, designing A and B values for it will make any kind of a sense. And if that is the case, what is this average level? The way people look at it is, in general, when I look at any time series equation, it is yt equal to a plus b into yt minus 1. So when it exhibits a mean reversion kind or covariant stationarity kind of a behavior, all I am seeing is a plus b yt. So the yt, so because the average is more or less the same across, I can very well substitute yt with yt minus 1 or anything, something like that. So based on that, it is coming out that yt into 1 minus b equal to a. From here, the yt, the long term mean reversion level will always come out as a divided by 1 minus b. If at all it is experiencing that kind of mean stationarity level, we say, okay, in this case, a, which is the intercept, divided by 1 minus the coefficient, that is the mean reversion level. 18,813 looks like the mean reversion level in the case of sense X, which means in case at any point in time it has gone above this 18,000 level, we see that over a period of time it will come back to this level. Even if it has fallen much below it, it can bounce back to that level. So at least this particular series is exhibiting some kind of mean reversion behavior, and what we see is any series will exhibit a mean reversion behavior if the coefficient of the lag variable is lying between minus 1 to plus 1. Lag variable coefficient is lying between minus 1 to plus 1, we say that that particular series is covariant stationary and it will exhibit a kind of a mean reversion behavior. So if you see that the lag variable coefficient is not lying between minus 1 to plus 1, we cannot say that the time series is exhibiting a mean reversion behavior or covariant stationary kind of a behavior. If that is the case, I cannot use autoregression models to predict that particular time series. Especially with respect to the financial and economic based models, we see a lot of non-stationary behavior being exhibited in the time series data, because the economy changes drastically, the conditions change drastically. So what we may see is the variables may not be floating around an average behavior. Sometimes in the short term they may behave around an average, but in long term there appears to be a constant or a big shift or drift in the values that are coming off. So basically sometimes it may look like it is better to do a forecasting or prediction for shorter terms rather than a longer term. So we have to really be worrying on checking out whether our particular distribution is covariant stationary or not. So in that A plus B, generally people look at, as long as this B value, the absolute of this B value is less than 1, means B value is lying between minus 1 to plus 1, not inclusive. B value lying between minus 1 to plus 1, we could see that that particular time series exhibits a covariant stationary kind of a behavior. Otherwise it is not. Now when I say otherwise it is not, then what could it be? That is where another concept is coming into picture. If it is not covariance stationary, I should look out for, is it going to exhibit some kind of random walk kind of a behavior. So basically if it is exhibiting some kind of a random walk, probably all we are trying to say is yt will be same as yt minus 1 plus some kind of an error term. So it may so happen that the expected value of this error term may become 0. So the way we are trying to model this, which is nothing but the coefficient here, if we see here, when I am trying to say yt equal to yt minus 1, in a general form we say yt equal to a plus b yt minus 1 plus some error term. Now here it means that if b is equal to 1 and a is 0, we are directly calling that kind of model as a random walk kind of a model. And if I see, yeah, a is non-zero, some other value, a plus yt minus 1 plus epsilon, where b is still 1, a is not equal to 1, a is not equal to 0, but b is still equal to 1, we are even talking about the random walk with some kind of drift. So with these kind of models, I cannot exhibit or I cannot use autoregression for the prediction purposes. Only when this particular model is neither a random walk nor it exhibits random walk with a drift, then only I am looking at it as covariant stationary, and which means if b is lesser than 1, then it exhibits a covariance stationarity, and if it exhibits covariant stationarity, then the value will follow a mean reverting level, and the value of the coefficient of the lag variable will be less than 1 itself. So how do I check out? Now the next thing for me is, only when the series is covariant stationary, then we are talking about mean reversion behavior, and then only we are talking of using the autoregression kind of models for predicting the value. Right, so in case the particular model is not covariant stationary, probably autoregression model itself will have some kind of issues. So from that standpoint, if I have to check out whether the model is stationary or non-stationary, we have already looked out for one of the mechanisms earlier. You go with a autoregressive model, take the error terms, find the autocorrelation of the error terms, and test out for significances of each of the auto correlations for each of the lags, and at no lag, if we are finding any significant autocorrelation, we can say that that model is covariance stationary, and the stationarity exists in that particular data. But on the other side, even more an appropriate and very effective test for checking out whether the model is stationary or not is what we are going with, a Dickey-Fuller test, a slightly much better method than a typical autoregression and testing out for the autocorrelations. We can use a Dickey-Fuller test to come out with whether the stationarity is existing significantly in the data or not. So getting into the Dickey-Fuller test, which is called as a DF test, all the process says is, okay, look at it like this: yt equal to a plus b yt minus 1. What the Dickey-Fuller test says is, okay, you subtract yt minus 1 from both sides. It becomes a plus b yt minus 1 minus yt minus 1. So this is nothing but the difference between the two y's, and take it as a plus b minus 1 into yt minus 1. So basically you check out now you create a regression equation. Whatever the output comes, that regression equation output, you test out whether it is statistically significant. Right, so let me do this process and then I'll explain it to you. Now here I will take yt minus 1. Okay, here if I take yt minus 1. So from this period I can take yt, which is the sensex at this point, minus yt minus 1. So this is my dependent variable now. So this is the dependent variable and I will take yt minus 1 as the independent variable. So now I will take the regression. This is the dependent variable and this is my independent variable. So yt minus 1. So this number will be my independent variable and this value will be my dependent variable. Right. So using these two, let's say I am doing a regression. What comes out with the Dickey-Fuller is take this as the dependent variable and let the independent variable be the I column itself. Right, now using this, let's say when I am doing this, okay, so the coefficient is coming out as 3881. Right, so in this case what is coming out is 3881 minus 0.2 times yt minus 1. Means in a way it is saying b minus 1 is somewhere equal to minus 0.2. That is what this is saying. Now what I would like to test out is what is the significance associated with it. The significance associated with it is 0.02. The significance associated with it is 0.02, which is less than 0.05. And because of that I can very well say that this variable is statistically significant. If this variable is statistically significant, this coefficient cannot be equal to 0. So b minus 1 cannot be equal to 0. So b cannot be equal to 1, which means it is not unit root. If it is proved that if at all in this case my null hypothesis cannot be rejected, which means the coefficient here, if it has come that it is significant, that is not statistically significant, then it would have been same as 0, which means b minus 1 would have been same as 0, then b would have been more or less same as 1. Wherever b has come out more or less as 1, we will say that that is not covariant stationary. So there is a possibility of random walk or unit root present in the data. So because of that, if at all we are seeing that the data is containing unit root, which means if this coefficient had not been statistically significant, then I could have directly said that this particular model is not covariant stationary and it exhibits some kind of unit root behavior. That is what we can use the Dickey-Fuller test, wherein we take the differences of the original values as the dependent variable and a period lag value as the independent variable. So the lag value is the independent variable and the difference between the current and the lag values is the dependent variable, and do the regression process. And in this case, if the coefficient of the lag variable comes out to be not significant from 0, it means that the coefficient of the original is not significant from 1, so I cannot consider that the particular distribution is covariance stationary. I may have to go with the assumption of it being a unit root. Now, if this particular distribution is not covariance stationary, then I cannot use any kind of autoregressive model on the top of it. So that is where, if at all, okay, in this example we did not get it as unit root, or in this example we did not get it as random walk. We got the data as covariance stationary itself. But in case the data is not covariance stationary, what is the process of going further to come out with a time series model? That is where we use a phenomenon called a first differencing kind of a mechanism. The first differencing kind of a mechanism is what we take up, wherein we take the differences between each of the periods, right? Just like the way we have assumed that this has been a covariance stationary, I'll take this difference, the first difference. Then similarly I'll take one more, this as the dependent variable. The yt minus 1 is what I take as the dependent variable, and probably yt minus 2 minus yt minus 1 is taken as the independent variable. So the independent variable will be taken as something like this, and a new regression equation would have been formed with these two things. In case my value had been not covariance stationary, the y intercept would have been, the y dependent variable would have been yt minus 1, and the independent variable would have been this difference, yt minus 2 to yt minus 1 would have been the independent variable, and I would have worked out with this kind of a regression equation. But of course here it is saying when I am taking the differences, the p-values are not significant, means the coefficient is not significant. But if at all the original data had been a unit root and not covariance stationary, when I had taken this kind of yt minus 1 to first differences, it could have easily resulted in a data which is not covariance, which is covariance stationary, and thus eliminated the concept of unit root. So what you would be predicting is the difference in the values, but not the original. So once you know the differences, you can either add back or subtract from the previous period value to get the prediction for the next period. So first differencing is a mechanism that would have helped you in terms of analyzing a data which already has a unit root and doing some kind of predictions based on that particular data. To make it to convert it into covariance stationary, if at all my time series is having a unit root, in order to convert that time series into covariance stationary, I could have got into the process of first differencing and taking the first difference values as the independent variable and the lagged first differences as the independent variable, and come out with a AR kind of a model, right? So that is one more dimension that we need to be comfortable with when we look at the time series kind of a data. Then the next important aspect which I would look at in the time series data is the concept of seasonality, right? Sometimes our data will exhibit some kind of seasonal behavior. When I say seasonal behavior, probably every 6 months there could be an increase, or every Jan there could be an increase, or every Q1 there could be an increase, whereas the remaining 3 quarters there would be a fall. Especially if we look at some kind of sales data Think of a winter clothing based sales data. Probably during the winter the sales could be much higher, whereas when the summer comes, the sales for those things will typically fall down. So there is a possibility that our data can exhibit some layers of seasonality. So whenever the data is exhibiting some layers of seasonality, how do you detect that? And based on that, how do you make the necessary adjustments to do the better prediction in the time series model? That is what we will look at right now. How do I test whether the seasonality is present in the data? And when we talk about seasonality, probably the growth is not so constant like this. Okay, for some period it is up, then it has gone down. Let's say this is January of a particular year, and probably by the time it came to December, it came here, and again in Jan it may touch like this, and then by April it may touch the peak and it may come down. So this is what we are calling as the seasonality kind of a behavior in the data. So if at all I have to check out whether the seasonality is present or not, the autocorrelation which we have done earlier itself for different lags, the autocorrelation which we do for different lag periods, right? You can find out with lag 1. So initially you can start off with any of your model, let's say yt equal to a plus b yt minus, any model which we are going ahead with. You start with that particular model, then whatever the residuals are there, take the residual, the correlation of the residuals with, let's say, lag of 1 or lag of 2. So you find out the correlations with probably up to lag of 12 or something if it is a monthly data, or try out up to a lag of whatever, different kinds of lags try out, and then divided by square root of 1 by square root of 1 by t, which is the standard error in this case. Use that to typically find out the t values and see whether any of these autocorrelations are statistically significant. If these autocorrelations are statistically significant, means somewhere, let's say with 12, means Jan 10 to December 13 or December 12, and Jan 11th to December 13th. If I take the correlation between these two data sets or between these two residuals, if they are very heavily coordinated, if they are very heavily correlated, means the auto correlation exists between these residuals, then I can very well think of the autocorrelation being present in the data. I can very well look out for the autocorrelation being present in the data, and if at all the autocorrelation is present, all I should do is, along with considering yt equal to a plus b yt minus 1, I would also consider c yt minus 12 as one more independent variable in my regression analysis. That is one way we can immediately account for the seasonality adjustment as a part of our predicted model. If at all we see that seasonality is being present, immediately you take yt minus 12 as another input and go ahead with your regression model, and whatever the coefficients that are coming out. After that, you try looking at the residuals with different lags. The correlations, the correlation between the pairs of residuals will drastically come down, and they will not be statistically significant. Then in that case, you might have incorporated the seasonality quite comfortably as a part of your regression model. Even that is one more aspect, especially when you have some kind of seasonalities present in your data, especially when you are trying to model the sales data which have a lot of seasonality behavior in them. The better way you address the seasonality is using this kind of an approach. So especially if your data contains seasonal data, better we need to remove for the seasonality before we getting into the prediction using a time series model. That's one more aspect we need to be comfortable with when we are dealing with working with time series models. Then the other important thing that I would like to give, just bring a little bit of flavor here, is the understanding of conditional heteroscedasticity, which we have discussed a little bit as a part of our multiple regression process. And how do I take it as a part of autoregressive conditional heteroscedastic kind of a model? These are some of the models which use autoregression as well as conditional heteroscedasticity behavior to predict the variances. If at all I am more interested in modeling the variances, not the mean or the values, if at all I want to look at modeling variances based on the time, I can use these conditional heteroscedasticity based autoregressive models, which are typically classified as arch kind of models. We can look at the mechanism of how to address these kind of arch models now. So the typical assumption again is the variances need to be constant. See, till now when I looked at, if the distribution needs to be covariance stationary, we said that the expected values or the means need to be constant, which means there should be some kind of mean reverting behavior in the data. If it is not mean reverting, then probably it may have a unit root or a random walk kind of a behavior. And if at all the random walk kind of a behavior is present in the data, I can do the first differences to the data and then try to convert it into a covariance stationary, from where I can use the autoregressive model to typically do the time series forecasting. Another major assumption of using the autoregressive kind of models and time series forecasting is the volatility or the variance also need to be constant. But if at all the variance is changing quite drastically, that is where we are thinking of using these conditional heteroscedasticity based models, or in short the arch based models. So one of the mechanisms to test out whether this conditional heteroscedasticity is present in our time series model is you take the error terms. In our data we had this as the error term, right? B minus J, yeah. This is the error term. These are the error terms. So what we are suggesting is you take the error squared, right? When you are using yt minus 1, let's say this is the error that has come. So you take the error squared. The error squared, when I am taking it, okay, this is the error squared, right? Now here when I say, when I take this as the dependent variable, now error squared, what this checking model for conditional heteroscedasticity says is the error t squared is equal to a plus b times error t minus 1 squared plus some error term and another error term, some alpha. So if this b is significantly different from 0, means if the coefficient of this kind of a regression is statistically significant, then I say there is a conditional heteroscedasticity of order 1 that is present in the data. So we find that this is an arch 1 kind of conditional heteroscedasticity being present in the data, so we may have to adjust for that kind of conditional heteroscedasticity to use the time series prediction model more and more accurate. So this is the expected t squared, error squared. Then what I could also do is I'll insert few more columns. So error t minus 1 squared. So basically here I am taking this particular error square directly, and now I am doing some kind of a regression equation again. Now when I am taking this regression equation, wherein this time my dependent variable will be this particular numbers, and the independent variables are going to be these numbers. Now let me see. Yeah, here we are seeing that the variable is 0.06 minus 0.06 and the p-value is 0.64. So at least I can say that this coefficient is not statistically significant. So because the coefficient here b is not statistically significant, I can very well assume it to be 0, which means it is not an ARSH1 kind of a model, or conditional heteroscedasticity is not present in this time series model. But if at all the conditional heteroscedasticity is present, then we may have to go with some kind of procedures like generalized least squares method, which I am not covering in this. But in case the conditional heteroscedasticity is present, or probably doing some kind of corrections to the standard errors, the White's correction kind of thing, which we have looked at earlier. Some kind of corrections to the standard errors we can do, and then reuse them to recompute the t values, and based on that look at the adjusted significance levels of the coefficients and then working out. So we have to test out not only for the constancy of the mean in the time series model, because the autoregressive models will play an important role, are really important only when my time series exhibits a covariant stationary kind of a process. And if it has to be covariance stationary, as we have been discussing, the expected value should be the same, which means there should be a mean reverting behavior in the data, and the variances of the data across the various time periods also should be constant. So it should not exhibit some kind of conditional heteroscedasticity specifically in the data. So if at all my data is having ARSH errors in it, right, based on this I need to go ahead in terms of predicting the values for the future. If at all I have to get into the predicting the values for the future, if I know that there are some kind of ARSH errors that are present in the data, then I am using a slightly different model for that. So at least we can predict the variance in the next period by using this. So if I know that this is the variance in the current period, and I know the values of A and B, I can use them to predict the variance of the next period. So it becomes error t plus 1 squared is equal to A plus B times error t squared. So basically this kind of an equation can very comfortably be used to predict what could be the variance in the time series for the next period. So that's how the conditional heteroscedasticity based models can be used to predict the variances for the coming periods, especially if the data is having some kind of conditional heteroscedasticity being present in it. And one more aspect that I would like to look at is whenever we are looking at various time series variables, especially in combination. Till now we have been using the time series variables in isolation, only one variable, but probably I may take yt as well as xt. Probably it may say that this is for a particular company. I am looking at historically the sales and historically the profits, or historically the sales and historically the profits, or historically the profits and the share prices. So when I am taking two different variables across the time, that is a kind of combination present in the data. So we are taking two different time series data. So whenever we are working with two different time series data, then the two major things that we have to look out for is the stationarity, or check out for the non-stationarity behavior in both of them, and also check out for what we call as co-integration behavior. Especially when I am talking about two variables together, I have to check out for these two different aspects. Are both of them non-stationary, or both of them are stationary, or only dependent variable is stationary, or independent variable is only stationary. So basically we are talking about the various scenarios like both of them stationary, y is stationary, x is also stationary, or it could be very much possible that y is stationary but x is non-stationary, or it can so happen that y is non-stationary whereas x is stationary, and it may so happen that both x and y, both of them are non-stationary. If this is the case, how do we really go about using the time series analysis if all these scenarios are coming into picture? So before we do with any other details into the process, we need to understand the mechanism of the co-integration, which means co-integration is a mechanism that these two time series, whatever we are looking at, they have some kind of economic linkage between them, some kind of meaningful relationship existing between them, and that existing relationship may not change in future. That is what is the meaning of co-integration. So probably it may so happen, though they may be non-stationary, I would like to know whether they are co-integrated at least. So in the non-stationary, both of them being non-stationary, I would also look out, are both of them co-integrated, means a definite regression relationship exists between both of them, or even they are not co-integrated. So basically I am checking out for 5 scenarios, both of them being covariant stationary, only one of them is covariant stationary while the other is not. Both of them are not stationary, but again within that, is any one of them are both of them co-integrated or non-co-integrated. So these are the various scenarios that can work out for us, right? And when I am working out on any of these aspects, I should typically look out for some of these situations. How do I test out whether this particular time series where I took y and x values is covariance, is co-integrated or not? What you can do is, you can do a regression relationship between y and x, just like using yt equal to a plus bxt. You take a regression relationship between y and x and then test for this particular b value, is it more similar to or is it more equal to 1 using a Dickey-Fuller kind of a test. If we say that this value is more or less equal to 1, then it is more similar to that of unit root and non-stationary with respect to a single variable time series analysis. So I'll check out whether this value is equal to 1 or not, and if it is not equal to 1, then I can very well assume that this particular data series is co-integrated, and whenever it is co-integrated, then I can even apply the autoregression model on the top of this. And just to summarize this process, especially in this case when both of them are stationary, and in this case when both of them are non-stationary and but they are co-integrated, only in these two cases we see that we can apply the regression kind of relationship, autoregression, linear regression kind of a relationship can be established between these two time series. But if one of them is covariant stationary whereas the other is not, which means probably if I am taking the growth rates as one thing and the increase as the other thing, there is a possibility that the growth rates will follow a mean reversion kind of a behavior, whereas the actual prices may not follow a mean reversion. It can keep continuously going up or falling down kind of a behavior. So this could be covariant stationary, whereas this may not be covariant stationary. Then it is not advisable to use, or then it is not apt to use a regression model in that context. Only when both of them are covariant stationary, as well as only when both of them are non-stationary but they are co-integrated, only in those kind of cases we can use the regression based time series models. So these are some of the things that are appropriate for us in terms of using the time series model. So the basic understanding of these various time series models is something which we should be comfortable with when we are doing any kind of analysis at any point in time. And in this process, a small offbeat thing generally that needs to be discussed is in sample versus out of sample forecasts. So generally what people do is to build a model. Let's say I have 40 sample data. Use all the 40 samples to build a regression model or autoregression model and test it on the 41st data is more like in sample forecast. So I am testing out on the data which I am using for my model building purpose itself. Whereas when I am talking about out of sample analysis, though I have 40 data points, probably I will use only the 35 of them to build the model and remaining 5 of them to test the model. So when I am testing it, when I am testing the model that is created with some set of values on a model which is completely a different set of values, then the accuracy of the model will increase quite drastically. And basically whenever we are testing our AR models and all, what we typically look out for is, especially when I do an out of sample forecast, the advantage is these 5 are completely new, where the input, where I know the output, where I know the actual value, but I did not use it to the prediction purpose at all. So what we can very well do is I can find out root mean squared error. What is this? Error, difference between the predicted minus the actuals, squared error. Take the average of that and take the standard deviation, because we have take the square root because we have squared it. So the root mean squared error, do it for the out of the sample data as well as in sample data. If both of them are resulting more or less in a similar or probably slightly lesser for this out of the sample data, then probably the model accuracy is much more compared to directly doing everything on an in sample or using all the data to build the sample as well as testing it on the same sample. It might so happen that our predicted model may break down sometime in future. So just as a word of understanding, especially when I am doing the predictions using the time series models, it's always advised that we work out with both in sample as well as out of sample kind of predictions, so that this kind of issues really don't crop up in the process. Even when I test it on the data for whose the output is already known, but I am trying to test out on that because I did not use it as a part of my model building process, and if the error is not significantly different when I compare it with those which have been used to build the model, then probably it gives me a lot of confidence that I can roll this model to the new data quite comfortably. So these are some of the things that we need to be comfortable with when we talk about the basic time series analysis on any data. I hope you are comfortable with all these various aspects. In case you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.